You've probably watched the news one day and heard something like this. The stock market lost $2 trillion today. And your first thought is, where did it go? Did someone take it? Did it just disappear into thin air? Did somebody sitting in a big office somewhere walk away with all of that money while everyone else was losing theirs? It's a fair question, and the honest answer might actually surprise you. Let me explain this in the simplest way possible. When you buy a share of a company, let's say you buy one share for $100. What you're really doing is agreeing with the market that that company is worth that price. You're not buying a physical thing. You're buying a belief that this company is valuable, that it will grow, that other people will also agree it's worth at least $100, maybe more, in the future. Now imagine tomorrow something bad happens. Maybe the company reports bad earnings, maybe there's a war, maybe people just get scared. Suddenly, nobody wants to pay $100 for that share anymore. The best offer on the table is $60. So now your share, yet which you paid $100 for, is only worth $60 on paper. Here's the key phrase I want you to hold on to. On paper. You haven't actually lost $40 in cash yet. What you've lost is the value that existed in people's minds. The belief changed. The agreement changed. And when the agreement changes, the number changes. That's all a stock price really is. It's the latest agreement between a buyer and a seller about what something is worth. So when people say the market lost $2 trillion, what they really mean is the total value that people believed the market was worth went down by $2 trillion. That belief, that agreed upon number, shrank. Not because someone stole the money, but because people stopped agreeing that things were worth as much as they thought yesterday. Think of it like this. Imagine you own a house. Someone tells you it's worth $200,000. You feel good about that. Then the neighborhood changes, fewer people want to move there, and now someone tells you it's only worth $150,000. Did you lose $50,000? Not exactly, and because you never had that $50,000 in your hands to begin with. It was only ever a number that existed in the market's opinion. The moment the opinion changed, the number changed too. That's exactly what happens in a stock market crash. Opinions change. Fast. Now here's where it gets interesting. While most people are losing value on paper, there are some people who actually do make real money when the market falls. These are people who do something called short selling. Without going too deep into the mechanics, short selling basically means you borrow a stock, sell it at today's high price, wait for the price to fall, buy it back at the lower price, return it, and keep the difference. So while everyone else is watching their values go down, these people are watching their bank accounts go up. There are also people who move their money out before the crash into things that hold value. Gold, government bonds, cash, real estate. The market going down doesn't affect them as much because they already stepped aside. They didn't lose the belief value because they turned it into something real before the belief collapsed. And then there's the third group, the ones who don't sell at all. They sit still. They've been through crashes before and they know one thing that the panicking crowd often forgets. The market has always come back, every single time in history, after every crash, every recession, every war, every pandemic, the market eventually recovered and went higher. Not immediately. Sometimes it took years, but it came back. So the money doesn't really go anywhere in the way most people imagine. It doesn't flow into one giant account somewhere. It doesn't get transferred to a secret group of rich people. What happens is simpler and in some ways more unsettling. Perceived value evaporates. The number that represented what people believed things were worth simply gets smaller, like air leaving a balloon. The air doesn't go somewhere specific when it just disperses. It's gone from the balloon, but it didn't become something else. The real danger in a crash isn't actually the crash itself. It's what people do because of it. The person who panics and sells at the bottom is the one who turns a paper loss into a real loss. Before they sell, the loss exists only in numbers on a screen. The moment they sell, they lock that loss in. It becomes permanent. The market can recover a year later and it won't matter. They already took the hit for real. This is why the most powerful thing you can do as an everyday investor is understand what a crash actually is. It is not a theft. It is not a transfer, it is a change in collective belief. And collective belief, as history has shown us again and again, can and does change back. The people who understand this are the ones who stay calm when everyone else is running. They know that fear is contagious, that prices can fall far below what things are actually worth, and that the gap between price and value is where opportunity lives. So the next time you hear that the market dropped $1 trillion in a single day, don't ask where the money went. Ask instead, who kept their head? Who stayed in? Who maybe even bought more while prices were low? Because those are the people who, when the belief returns, and it always returns, will benefit the most. The market rewards patience more than it rewards intelligence. And it punishes panic more than it punishes ignorance. That's where the money goes. It goes to the people who didn't run. If this helped you see things a little more clearly, share it with someone who's been asking the same question. And if you want more of these kinds of explanations, simple, honest, no fluff, make sure you subscribe. We've got a lot more of this coming.